If you're 65 or older and you're still doing your taxes the same way you did 10 years ago, there's a real chance you're handing the IRS thousands of dollars that legally belong to you. And heads up, this is general information, not personal tax advice, because every situation is different. Now let's get into number one, because this one alone could be worth $6,000 a year. Here's the thing nobody warns you about. The tax code changes almost every single year, but most retirees are still filing the way their accountant told them to file back when they first retired. And when the rules shift, and you don't shift with them, you don't get a warning letter from the IRS saying, hey, you missed something. You just quietly pay more than you have to, year after year. For some couples, that adds up to $15,000, $20,000, even $30,000 over a decade. Money that could have covered a grandchild's tuition, a new roof, or just breathing room in a fixed income budget. Think about it this way. You worked for decades, you paid into the system, and now you're finally on the other side of it, supposedly the part where the rules are supposed to work in your favor. But tax software doesn't call you up and say, hey, by the way, there's a new deduction with your name on it. Your Medicare provider doesn't send a note saying, your premium just quietly went up because of a decision you made 2 years ago. You find out, if you find out at all, when the numbers already don't add up, when the refund is smaller than you expected, or when the Medicare bill arrives higher than last year with no clear explanation attached to it. And right now, in 2026, there's a specific reason this matters more than usual. Congress passed a massive tax law last year called the One Big Beautiful Bill Act, and it rewired several rules that apply specifically to people 65 and older. Some of these changes are brand new. Some are old rules most people never knew existed in the first place. Either way, if you're not using them, you're leaving real money on the table. And unlike a lot of retirement content out there, this isn't about some bill that might pass someday. Everything in this video is already law, already in effect, and already something you can act on for your 2026 taxes. Now, where does all of this actually come from? It's not a rumor, it's not a YouTube theory, it's written directly into the tax code. The senior deduction I'm about to walk you through comes straight from the One Big Beautiful Bill Act, signed into law on July 4, 2025, and the IRS has already published official guidance on it, including a dedicated fact sheet on tax deductions for seniors. The Medicare premium rules come from the Centers for Medicare and Medicaid Services and the Social Security Administration, who publish updated premium and surcharge tables every fall for the following year. The charitable giving and standard deduction figures come from IRS Revenue Procedure 2025-32, the official document the IRS releases each year listing the exact dollar thresholds for the year ahead. And the pension-related Social Security fix comes from the Social Security Fairness Act, a separate piece of legislation Congress passed in January 2025. None of what I'm about to tell you is speculation, and none of it requires anything to pass in the future. It's already in effect for your 2026 taxes, right now, whether your tax preparer has mentioned it to you or not. So let's go through it, one piece at a time, starting with the biggest one. Number one, there's a brand new $6,000 deduction just for turning 65, and it's separate from anything you've claimed before. Starting with the 2025 tax year and continuing through 2028, if you're 65 or older, you can claim an additional $6,000 deduction, on top of your regular standard deduction, and on top of the extra deduction seniors have always gotten for being 65 and up. If you're married and both of you are 65 or older, that's $12,000 combined. And here's the part most people miss. You get this whether you take the standard deduction or you itemize. It doesn't matter which way you file. Let's put real numbers on it. Say you're single, 68 years old, and your income for the year is $70,000. Your regular 2026 standard deduction is $16,100. On top of that, you get the existing age 65 addition, which for 2026 is $2,050. And now, on top of both of those, you get the new $6,000 senior bonus. Add it up and you're deducting $24,150 before you even look at a single itemized expense. That's not a small adjustment. That's real tax savings, potentially over $1,000 depending on your bracket. Now here's where it gets important. This deduction phases out if your income is too high. For single filers, it starts shrinking once your modified adjusted gross income crosses $75,000, and for married couples filing jointly, that threshold is $150,000. It phases out at 6% of the amount you're over the limit. So if you're a single filer with a modified adjusted gross income of $90,000, you're $15,000 over the threshold, and your deduction gets reduced by about $900. Most people stop here, but don't, because here's the mistake retirees make constantly. They don't realize that a Roth conversion, a big required withdrawal, or even selling an investment can bump their income just enough to shrink or wipe out this deduction. If you're close to that $75,000 or $150,000 line, timing matters enormously. Number 2, and this one is honestly one of the most overlooked provisions I've seen in years. If you don't itemize your taxes, you've probably assumed you get zero tax benefit for giving to charity. That used to be true. Starting with 2026 returns, it's not true anymore. There's a brand new deduction, up to $1,000 for single filers and $2,000 for married couples filing jointly, for cash donations to charity, even if you take the standard deduction. Here's why this matters specifically for retirees. A huge number of seniors give to their church, a food bank, or a community organization every year and never see a dime of tax benefit because they take the standard deduction, like almost everyone does now. This new rule means if you're single and you donate $1,000 in cash this year, you can deduct that full amount separately, no itemizing required. Now here's the part they never tell you. If you're 70 and a half or older and you have a traditional IRA, there's an even more powerful version of this called a Qualified Charitable Distribution, or QCD. And I want you to remember that term because it's coming up again in a minute. Number 3. If you're 73 or older, the IRS is forcing you to take money out of your retirement accounts, whether you need it or not, and most people take it the expensive way. Once you turn 73, if you were born between 1951 and 1959, or 75, if you were born in 1960 or later, the IRS requires you to withdraw a minimum amount from your traditional IRA every single year. This is called a required minimum distribution, or RMD. And here's the trap. Every dollar of that RMD counts as taxable income, whether you spend it, save it, or don't need it at all. Miss it, and the penalty is brutal. 25% of the amount you should have withdrawn, though that can drop to 10% if you catch and fix the mistake within 2 years. But here's what most retirees don't know. You can send that RMD, or part of it, directly to a qualified charity instead of taking it as cash. And if you do, it doesn't count as taxable income at all. That's the Qualified Charitable Distribution I just mentioned. For 2026, you can direct up to $111,000 per person this way, and if you're married, your spouse can do the same from their own IRA, for up to $222,000 as a couple. Here's a real example. Say you're 75, your RMD for the year is $60,000, and you already give about $20,000 a year to your church or a cause you care about. If you take the full $60,000 as cash and then write a personal check for $20,000, you're taxed on the entire $60,000. And if you take the standard deduction, that charitable check gets you nothing. But if you send that same $20,000 directly from your IRA to the charity as a QCD, only $40,000 of your RMD counts as taxable income, and the charity still gets the exact same $20,000. Same generosity, thousands less in tax. And here's the part that surprises people the most. You don't have to wait until you're forced to take RMDs to use this. You can start QCDs at age 70 and a half, up to 3 years before RMDs even begin for most people. So say you're 71, you haven't hit your RMD age yet, but you already know you'll be sitting on a large IRA balance when you turn 73. Every dollar you move out through a QCD now, before RMDs even start, is a dollar that never has to be forced out later, which means smaller required withdrawals down the road and less pressure on your tax bracket for years to come. A lot of retirees don't realize this window even exists, and they wait until the IRS forces their hand instead of getting ahead of it voluntarily. Number 4, your Medicare premium can jump by hundreds of dollars a month because of a single dollar of extra income, and almost nobody sees it coming until the bill shows up. This is called IRMAA, the Income-Related Monthly Adjustment Amount, and it's one of the cruelest cliffs in the entire tax and benefit system. For 2026, if your income crosses $109,000 as a single filer, or $218,000 for a married couple filing jointly, you don't just pay a little more, you jump into an entirely higher premium bracket for both Medicare Part B and Part D. The standard Part B premium in 2026 is $202.90 a month. Cross that first threshold, and your premium can jump by over $80 a month per person, and it climbs from there across 5 separate income tiers, all the way up to an extra premium of hundreds of dollars a month at the highest levels. Here's the trap. Medicare looks at your tax return from 2 years ago to set this year's premium. So the income that determines what you're paying in 2026 is actually your 2024 tax return. That means a big one-time event 2 years ago, selling a house, a large Roth conversion, cashing out an investment, can be quietly costing you extra Medicare premiums right now, even if your income has since gone back down. Now here's the part they never tell you. If that spike in income was caused by something specific, like retiring, losing a spouse, or a one-time event that no longer reflects your current situation, you can appeal it. There's a specific form for this, and I'll give you the exact number in a minute. Let's make this concrete with numbers. Say you're a married couple, both on Medicare, and your combined 2024 income landed at $240,000 because one of you was still working part of that year. That puts you above the $218,000 threshold, into the next IRMAA tier, adding roughly a couple $100s a month in extra premiums, for both of you, for the entire year. Over 12 months, that's real money, often several $1,000s as a couple, for a bracket that was only crossed because of income you earned 2 years ago, income that may not even reflect your life today. Number 5. Up to 85% of your Social Security check can be taxed, and the income limits that decide this haven't been updated in over 4 decades. This one catches people off guard because it feels unfair, and honestly, it kind of is. The thresholds that determine whether your Social Security benefits get taxed were set back in the 1980s and 1990s, and unlike almost everything else in the tax code, they've never been adjusted for inflation. If you're single and your combined income, that's your adjusted gross income plus non-taxable interest, plus half of your Social Security benefit, crosses $25,000, part of your benefit becomes taxable. Cross $34,000 and up to 85% of it can be taxed. For married couples filing jointly, those numbers are $32,000 and $44,000. Because these numbers never move while everything else, pensions, part-time income, investment income, keeps growing with inflation, more and more retirees get pulled into taxation on their Social Security every single year, even though nothing in the law technically changed. Most people stop here, but don't, because this is exactly why strategies like QCDs and careful RMD timing matter so much. Every dollar you can legally keep out of your adjusted gross income doesn't just lower your regular tax bill, it can also keep less of your Social Security check exposed to taxation in the first place. Take a retired couple with $40,000 combined in Social Security benefits and $30,000 in pension and interest income. Half of their Social Security benefit alone, $20,000, gets added to that $30,000 for the purposes of this test, putting their combined income right at $50,000, well above that $44,000 threshold, meaning up to 85% of their Social Security benefit can end up taxable. Shave $10,000 off that other income, through a QCD, through careful timing of a withdrawal, and that couple can meaningfully reduce how much of their Social Security check the IRS gets to touch. Number 6. There's an extra standard deduction just for being 65, separate from the new $6,000 bonus, and a lot of retirees don't realize they're allowed to stack both. This is the older, quieter cousin of the new senior bonus deduction, and it's easy to confuse the two, so let's be precise. For 2026, if you're 65 or older, you get an additional standard deduction of $2,050 if you're single, or $1,650 per qualifying spouse if you're married filing jointly. This is completely separate from and stacks on top of the new $6,000 senior bonus deduction we talked about in number 1. So a single 68-year-old isn't just getting the regular standard deduction plus the new $6,000 bonus, they're also getting this extra $2,050 on top of both. Here's the mistake people make. Some tax software and some preparers don't clearly separate these out on the summary page, so retirees see one combined number and assume that's the maximum available, without realizing there were actually three separate deductions stacked together to get there. If your return doesn't clearly show a base standard deduction, an age 65 addition, and a senior bonus deduction as three distinct lines, it's worth asking your preparer to walk you through exactly where each dollar came from. Number 7. If Medicare quietly bumped your premium into a higher bracket, there's a specific form that lets you fight back, and almost nobody uses it. Remember IRMAA, the Medicare premium surcharge we talked about in number 4. Here's what most retirees never learn. You have the right to appeal it, and the form is called SSA 44. If your income dropped because you retired, because you lost a spouse, because you had a divorce, or because of certain other specific life-changing events, you can file Form SSA 44 with the Social Security Administration and ask them to use a more recent lower income figure instead of the 2-year-old tax return they'd normally use. Here's a concrete example. Say you were working full-time in 2024 and earned $140,000, but you retired in early 2025 and your income dropped to $55,000 going forward. Without filing anything, Medicare would still charge you the higher 2026 premium based on that 2024 income, because that's the default lookback. File Form SSA 44 with documentation of your retirement, and the Social Security Administration can use your actual current lower income instead, potentially saving you well over $1,000 a year in Medicare premiums. Most people never even hear this form exists, and that's exactly why so many retirees are stuck overpaying for years after a life change that should have lowered their bill. Number 8, and this one applies specifically to retirees who also worked in a public sector job: teachers, firefighters, police officers, postal workers, and some government employees. For decades, two rules called the windfall elimination provision and the government pension offset quietly cut or completely wiped out Social Security benefits for people who also received a pension from a job that didn't pay into Social Security. If you were a teacher for 30 years and then worked a few years in the private sector, you might have paid into Social Security during those private sector years, but the old rules could still shrink or eliminate the Social Security benefit you'd otherwise be owed. That changed with the Social Security Fairness Act, signed into law in January 2025, which repealed both the windfall elimination provision and the government pension offset entirely. If you're one of the roughly 2 million Americans affected by these old rules, you may now be owed a higher monthly benefit going forward, and in many cases, a retroactive lump sum covering benefits going back to January 2024. Here's the mistake people make. Some retirees assume the Social Security Administration automatically recalculated everyone by now and never bothered to check their own benefit statement. If you or your spouse ever worked a job with a pension that didn't withhold Social Security taxes, and you haven't specifically confirmed your current benefit reflects this repeal, that's worth checking directly with the Social Security Administration, not assuming it was handled. Okay, so here's your one action step for this week, and I want you to actually write this down. Pull out your most recent tax return, your most recent Medicare premium notice, and your most recent Social Security benefit statement, and check 3 things. First, does your tax return clearly show the $6,000 senior bonus deduction, separate from your regular standard deduction and the age 65 addition? If you don't see it broken out as its own line, call your tax preparer and ask directly. Second, look at the income figure Medicare used to set your current premium. If your income has genuinely dropped since then because of retirement, a spouse's passing, or another qualifying life event, go to ssa.gov, search for Form SSA 44, and start the appeal process this week. Third, if you or your spouse ever worked a job with a pension that didn't withhold Social Security taxes, log into your ssa.gov account and confirm your current benefit reflects the windfall elimination provision and government pension offset repeal. Those 3 checks alone, for a lot of retirees, are worth more than an hour of anyone's time has ever been worth in this economy. If this helped you make sense of what's actually changed for retirees this year, hit subscribe, because every week we break down exactly what the IRS and Social Security are doing differently. In plain English, no jargon, no guessing. And if you want the deep dive on exactly how required minimum distributions work year by year as you age, that video is coming up next. And trust me, it's one every IRA owner over 65 needs to see before their next withdrawal.